All right. Thank you again for joining JMT Consulting for our expert speaker series. We're happy to have Matt Becker from BDO presenting today on new revenue recognition guidance, what nonprofit organizations need to know. This has been such a popular topic, and we have quite a large crowd today, so we're anticipating quite a few questions. So just to let everyone know, we may go over our 1 hour time frame. We want to make sure that you're aware of that, and if you need to drop off, you will get a recording of the presentation as well. This webinar is sponsored by JMT Consulting. We're an ERP and financial management solutions firm with 27 years experience that specializes in nonprofits. We work with a wide variety of software partners to find the best solution for your nonprofit. I'd like to share a few housekeeping notes with everyone, and then I'll turn it over to Matt. If you have any questions at all during the webinar, please submit your questions in the questions box on your control panel. Laura Willis, one of our solutions consultants, will facilitate answering questions at the end of the webinar. While we are reviewing questions, we will also launch a poll so we can learn a little more about our audience participants. Today's webinar and slides will be emailed to you and is being recorded. You should be getting that tomorrow in your inbox. Finally, I'd like to introduce Matt Becker. He's the director of BDO USA's nonprofit industry practice. He has over 14 years of expertise serving all types of nonprofit organizations. We are happy he is joining us today, and with that, I will hand it over to Matt.
Great. Thank you so much, Melissa. Thank you, Laura, and to everyone at JMT Consulting. I'm very pleased to be spending this afternoon with everyone, as this is a very important topic and, as always, certainly an interesting time for nonprofit organizations, specifically from a regulatory standpoint. We're going to talk to you today about the new revenue recognition guidance, more specifically geared toward what nonprofits need to know, as this ASU, which 2014-09, has been around for a couple of years, but as we're on the precipice of implementation for many types of nonprofits, we want to talk about what you need to know, what are the implications, what you need to start doing, and how you can really best position yourself and your organization to make sure your documentation is in order and you're following the standard guidance. So happy to be with you today. As Melissa mentioned, I'm audit director with BDO, working with many types of nonprofits for my entire career. As far as our agenda this afternoon, we want to talk about topic 606, revenue recognition. We'll go through an introduction to what the objective of the standard is, the scope of the standard, the effective date. We'll take a step back towards some recently issued guidance by FASB, talking about our grants subject to revenue recognition, what that means specifically for nonprofits. We'll get into some of the nuts and bolts of the standard itself, and then we'll talk about how to get ready and some implementation and next steps. So the objective here by the FASB was to develop a single standard, really in convergence with IFRS. The standard aims to improve accounting for contracts with customers. So that might be a term you hear, and we'll go through exactly what that means. They want to provide a robust framework for addressing any revenue issues as they arise, increase comparability across industries, and require some better disclosures. And I think simplifying and improving disclosures as well as documentation is a theme you'll see with a lot of the new standards that are being released. The scope of the standards includes all contracts with customers, except any lease contracts, insurance contracts, financial instruments, guarantees, or non-monetary exchanges. Contracts not with customers that are excluded include contributions and collaborative arrangements, and we'll get to what exactly that means as far as contributions are concerned, because that is oftentimes some of the main funding for nonprofit organizations. As far as the effective date for topic 606, it is effective for annual periods beginning after December 15th, 2017 for public business entities. Now, you may ask why we include that. The reason is that a nonprofit organization who may be considered a conduit debt obligor would have to adopt this during that time period with other public business entities. For those of you asking what a conduit debt obligor is, for example, if there is a nonprofit organization who holds municipal debt, for example, a bond that is issued by some type of dormitory authority or maybe an economic development corporation or any type of government entity where those securities happen to be listed or traded on an over-the-counter market. However, for the rest of the nonprofit organizations, there is an effective date of December 15th, 2018. So as you're aware, that's coming up toward the end of this year. For those of you interested, there is a full retrospective approach available should you decide to do so in advance of the effective date. As I mentioned, the recently clarified guidance from FASB in June came out regarding grants versus contributions, and I want to spend some time with you on that today because that's certainly very important as it pertains to everyone here. So, as I mentioned, we received a long-awaited clarification from FASB in ASU topic 958, really aiming to standardize how grants and other contracts are classified across the sector. And the real key distinguishing factor here is whether it's an exchange transaction or a contribution. Now, to get a little bit ahead of ourselves, this is called step 0 as we go into the 5-step process for the new standard. But I want to just take a step back with everybody and talk about, might not be telling you something you already know, but just to reiterate, what's an exchange transaction? We're talking about a reciprocal transfer in which a party receives and sacrifices something of equal value. On the other hand, a contribution is defined as an unconditional transfer of cash or assets in a voluntary non-reciprocal transfer. And we really want to delineate between the two. And we developed a practical example here so we can really understand, as I had mentioned earlier, contributions are exempt from the new revenue recognition standard. However, certain grants are subject to topic 606. And just to clarify where that falls, we've developed an example here, and let's walk through it together because we want to evaluate the grant under the new guidance. So put together a brief description of nonprofit organization A, which is a large research association specializing in space exploration. Their mission is advancing scientific discoveries, supporting new technology, and the organization receives funds, as I'm sure many organizations on this call do, from various different types, individuals, corporations, governments as well. So for our example here, nonprofit A received a $15 million grant from the federal government to finance the cost of a research initiative testing effectiveness of some new technology. The question is, how do we classify this as either an exchange transaction or a contribution? Because those exact parameters will really depend on whether or not we'll need to apply the new revenue recognition guidance to these amounts. So let's look at this example, taking it a step further, talking about some of the specific provisions of the grant. On one hand, we'll have to classify this grant as an exchange transaction, meaning it's subject to revenue recognition standard if the resource is paid by the government as the work is incurred and the request for payment is submitted. The federal government then also in this example specifies the protocol of the testing, the material, and such. And further, the government would require a detailed report as well as maintaining the intellectual property that may result as a fulfillment of this grant. Now, on the other side, if this grant specifically had the nonprofit make all the decisions, whereas in the previous side of this slide, the government makes decisions, and then the nonprofit in this other side would retain the IP, then we're looking at what we would consider a contribution. So you can see here what we're getting to is how the grant is written, each circumstance of the grant, and that's how the standard is going to have to be approached. Really going to have to not only inventory each revenue stream as far as grants are concerned, we're going to have to, on a retrospective basis, go back and look at the multi-year grants, and then going forward, understand what the ramifications are of the grant writing process. So the deciding factor here in the first example is if the federal government is considered to be receiving something of commensurate value. And that's really the bold type print here. Receiving something of commensurate value is really what clarifies this in his exchange transaction. However, on the other hand, if there's no commensurate value being exchanged, you would classify this as a contribution. It's then exempt from the new revenue recognition standard. And as you can see in this slide, whereas all exchange transactions are subject to revenue recognition, the scenario where it's a contribution, it is not subject to revenue recognition. Now, this will certainly affect the documentation that you'll have to keep on your end, as well as I mentioned, inventory these amounts. So what types of organizations need to take action here? Any nonprofits that receive grants from foundations, governments, or other funding really have to relook at how you're accounting for your contributions. As far as grantors are concerned, they'll need to think about how they write their grants and contracts. And if there's an ability for any of the organizations on the call here today, this is something to start thinking about, and I think is a key takeaway as far as that is concerned. Now, who won't experience a significant impact here? Many of the organizations who may derive a lot of their funding from individual contributions, whereas those are simply not exchange transactions, not subject to revenue recognition, and local, state, and federal governments as well. So that example will highlight what was recently clarified by FASB. So certainly very important, as it's a very common source of funding. And with that said, we want to get into the standard itself. So the final US GAAP model, the core principle, as I mentioned, was depicting the transfer of promised goods or services to customers in amount that reflects consideration to which the entity would expect to be entitled in exchange for those goods or services. Now, this very important 5-step process is very detailed. As I mentioned, documentation of each particular step within this process is key. For the first step, it's identifying the contracts with the customer, and we'll talk about a little more in depth about what each step means specifically. We'll talk about step 2, identifying the performance obligations within the contract, determining the transaction price within that contract, which oftentimes might not be quite as clear in some instances. We'll talk about how to allocate the transaction price in step 4, and then recognizing the revenue in step 5 when the performance obligation is satisfied. Now, in the beginning, we talked about, does the contract fall completely within the scope of other accounting guidance? For example, some of the aforementioned types of revenue, which are not included in Topic 606. However, if they do, you will have to apply Topic 606 and implement this 5-step model to revenue recognition. Now, I know sometimes a lot of these slides contain a lot of information, but what we really want to do is understand the 5-step process. And as I mentioned, talking about this earlier, step 0, is it a contribution versus an exchange transaction? We talked about that a bit before. I think once you understand if you have an exchange transaction, then we move to step 1. So step 1 is identifying the contract. And, you know, as you sit here, you might think, oh, well, it's not written, but these contracts can be written, oral, or implied by the entity's business practices. So the fact that you don't have a written contract does not mean that it does not fall subject to Topic 606. The contracts with customers must meet all of these criteria. So the parties must approve it and be committed to perform their respective obligations. Each party's rights regarding any goods or services to be transferred can be easily identified. Payment terms can be identified. There must be commercial substance, and it's probable that the entity will collect the consideration to which it's entitled. Now, oftentimes you may be in an instance where you have a combination of contracts or a single contract. So the consideration here is, are the contracts entered into near the same time with the same customer or related parties of the customer? If so, you have to account each contract as a separate contract. However, if they're negotiated as a package with a single commercial objective, whereas there also might be consideration to be paid in one contract depending on the performance of the other, these amounts have to be accounted for as a single contract. So while this may seem like an obvious step, this is an important first step toward the revenue recognition process under topic 606. So once we've been able to identify the contract, that leads us to step 2. And this is very important, is identifying separate performance obligations. So we talk about the definition here of a distinct good or service as something the customer, can the customer benefit from it either on its own or without readily available resources? If the answer is no, the good or service is not distinct. However, if the answer is yes, we then have to get to the next step. And I think you'll see that each of these steps, the documentation as to each particular criteria is very important. We'll be working with, a lot of nonprofit organizations to develop templates and various other materials so that you can document this should it ever get called into question for any reason. So if the answer is yes, is the promise to transfer a good or service separate from another, some of these indicators that might give you that is the entity doesn't provide a significant service, the good or service doesn't significantly modify or customize any other goods or services, or a good or service is not highly dependent. So in that instant, the good or service would be considered distinct. So as you review the contracts, you have to understand if you have a single performance obligation or multiple performance obligations here as you approach what leads us to step 3. So step 3 is determining the transaction price, that being defined as the amount of consideration to which an entity expects to be entitled in an exchange for transferring promised goods or services to a customer. This is excluding amounts collected on behalf of third parties, an example of which would be any sales taxes or various other third-party amounts. The consideration promised in a contract with a customer can vary in terms of nature and timing, and this may affect our determination of the transaction price. So we give specific consideration to 1, variable consideration, the existence of financing components in a contract, any non-cash considerations, and then as well to consideration payable to a customer. So we talk about variable consideration here. Now, this can arise due to many reasons. Some of those amounts might be discounts, rebates, any refunds or credits. Oftentimes, these might not be the case as much for nonprofit organizations, but it's worth noting any price concessions, incentives, or performance bonuses, any penalties, or the consideration is contingent on the occurrence or non-occurrence of a future event. So these are all the things we really need to start thinking about. And let's say that in this example or in this instance or any of the funding that you receive or any of the contracts that you may have, whether written, oral, or otherwise, or implied, we do have variable consideration. So in that case, what happens then? Well, like some other accounting amounts or principles, when there's variable consideration, the transaction price must be estimated. And the standard allows for 2 methods that can be used to estimate the variable consideration. 1, the expected value method, which is defined as the sum of the probability weighted amounts for a range of possible outcomes. So this is used more when there's a larger number of contracts with similar characteristics. And then the other way to determine that would be a most likely amount out of those possible range of outcomes where maybe there's only two outcomes. One method should be applied consistently throughout a particular contract. We need to consider all the information reasonably available, as you would with any other significant accounting estimate. Certainly looking at historical, current, and prospective trends to come up with what we would consider a reasonable number of possible consideration amounts. The estimate of variable consideration would need then to be updated at each reporting date. And certainly, as you might think, that there would be particular experience with working with similar funding, whether it's the same grantor or the same implied contract year after year or not. Nonprofit revenue streams don't vary as wildly, so you think there'd be information to be readily available to come up with one of these estimates. And as we mentioned, with any significant estimate, understanding and documenting the information to support those estimates is critical. So once we've come to a determination on the transaction price, that leads us to step 4, which is how you would allocate the particular transaction price to each performance obligation. Now, an entity would allocate and split the transaction price between the performance obligations in so much that it's based on the standalone selling prices of each identified obligation, which means the price at which an entity would sell a promised good or service separately to a customer. So, in determining the standalone selling price of a performance obligation, you need to understand, is there an observable price or good or service for sale in similar circumstances to similar customers? If yes, you use that price. Once again, no, going to have to look to come up with an estimate. Here, there's 3 particular approaches. You can use an adjusted market approach, an expected cost plus a margin approach, or a residual approach. And either of these 3 are acceptable. Like I said, coming up with the best estimate that you can support and document based on the information that you have would be the best way to choose the approach and then document that approach as well. So I want to talk a little bit more about the methods of determining the standalone selling price. In the adjusted market approach, you're going to estimate the price customers in the market would be willing to pay, considering reference to competitors' prices for similar goods, or in really this instance, similar services. The expected cost plus a margin approach would forecast the expected cost, then add an appropriate margin, and the residual approach would be the total transaction price less the observable standalone selling prices of the other performance obligations. I would expect that most organizations to complete step 4 would look to use the adjusted market approach, as there's probably a much better estimate in terms of the services that are being performed and the price those would be that the customers would be willing to pay. A quick caveat on, in order to use the residual approach, the criteria outlined below have to be met, whereas the selling price would vary significantly, or that there's so much uncertainty to the selling price that it hasn't been established, or that the service has not been performed or sold on a standalone basis. Another consideration for step 4, the determination of the allocation in the existence of discounts, where the sum of set standalone selling prices might exceed the promised consideration. So the allocation of the discount is made to either the particular specific performance obligations, or you would then allocate that proportionately between all performance obligations. So in this instance, specific allocation occurs only if there's observable evidence that there are regular sales of the services, or that the sales of the bundle are regularly priced at a discount. So once the allocation of the transaction price to the particular performance obligations is documented and you feel comfortable that you've met steps 1 through 4, that brings us to step 5, where the revenue is then recognized. So revenue is recognized when a nonprofit satisfies each of the obligations. The satisfaction finally occurs when the nonprofit transfers control of the goods or the services to the customer. To refresh, control is defined as the ability to direct the use of and obtain substantially all of the remaining benefits from an asset, or the ability to prevent others from doing so. So once we have this instance in place, we're talking about revenue recognized over time. So this is subject to various criteria under ASC 606, or 2, at a point in time, if the criteria for recognition over time under 606 are not met. Now, let's dive a little deeper into step 5 here as we talk about the revenue recognition process and the overtime criteria. So 3 criteria here as far as recognizing the revenue over time. Now, this is important, whether it's over time or at a point in time, as you think about what type of financial reporting models you're building, what type of cash flow projections you're putting together for your organization, internal budgets, annual reports, and other important reports that go to the stakeholders of your organization, whether that be management, those charged with governance, boards, if any organizations are required to meet certain debt covenants, or to present any information to a bank on a quarterly basis. These are some of the things to start thinking about as particular grants and contracts are going to be structured going forward. So to recognize revenue over time, the first criteria is that the customer simultaneously receives and consumes all of the benefits provided by the entity's performance as the entity performs. Secondly, the asset that's created or enhanced is then controlled by the customer. And 3, the entity's performance doesn't create an asset with an alternative use to the entity. And B, there's an enforceable right to payment for performance completed to date. So I know there's a lot of information in this, and we're going to take each one a little bit of a step further. So let's talk about a little more about each particular criteria, what that means, what has to be done in order to recognize the revenue over time. So criteria 1, the customer simultaneously receives and consumes all the benefits. Another entity would not need to re-perform the work already completed to date in order to fulfill the remaining performance obligation, and then the entity's work does not create an asset. An example of this would be work in process inventory. Most likely, only some particular service contracts would satisfy this criteria, not goods contracts. So talking a little bit more about criteria 2, the asset that's created or enhanced is controlled by the customer. An entity would need to consider the indicators of whether control has been transferred, as noted on the previous slide. As we mentioned, control, talking about the ability to direct the use and obtain substantially all of the remaining benefits from an asset. So I have to understand whether is there a present right to payment for the asset, who holds the legal title. In an instance where there's physical possession, has that been transferred? Have any significant risks or rewards of ownership been transferred? And has there been acceptance of the asset by the customer? So just a quick aside that this particular approach is similar to the rationale of the percentage of completion method, for construction contracts. So I'm not sure if anyone really has that affect their organization, but the fact that there's a continuous sale and that the customer controls the work in progress. So let's talk about criteria 3. The entity's performance doesn't create an asset with an alternative use to the entity. The entity has an alternative use for the asset if it could readily redirect the use of the asset both contractually and practically. Now, what we mean by that is if the asset can be readily interchanged with other assets produced by the entity, then there's really no substantive contractual restriction which would prevent the specific asset from being redirected or produced. In this instance, just talking about generic widgets. However, if there's no substantial cost on rework or no substantial loss on sale of the asset to another customer in its current state, then there's no practical restriction. So that really goes through the contractually as well as being practically satisfaction. So talking a little bit more about criteria 3, there's an enforceable right to payment for performance completed to date. So we're talking about enforceability as well as payment for performance completed. Now, oftentimes this may not apply in any contract, but certainly as we talk about these items, I can't stress enough how important it is to document. So talking about enforceability, you have to consider whether in some circumstances there's legislation or any legal precedent which confers a right to payment. Also, it's key to consider the entity's business practices in choosing whether to pursue rights or payments. As far as payment for performance completed, the amount need not be fixed, however, it must at least compensate an entity for the performance to date, and you must approximate the goods or services transferred to date, not merely compensation for loss or profit. So let's continue with step 5, as there's a lot of information here to consume. For revenue recognized over time, how is progress toward completion of the performance obligation determined? The method used as the basis of RevRec over time really must reflect the pattern of how the goods or services are transferred to the customer. And what we mean by that is the methods that are categorized as being either output methods, so talking about results, oftentimes there are particular milestones or particular criteria which would be outlined in the contract as far as output is concerned, or input methods, what type of resources are being consumed to meet these contract demands, whether we're talking about labor or machine hours, oftentimes talking about FTEs, full-time equivalents, or costs that are incurred. It's important to note that you must exclude from these methods any measure relating to goods or services that haven't been transferred to the customer. Also, a couple of other important notes: only one method per performance obligation really can be used. An application has to be consistent for similar performance obligations. Finally, subsequent changes in the methods are used in a change in accounting estimate. So if there is the subsequent change to using output methods versus input methods, you'd have to consider that a change in estimate. So we talked a lot about, in step 5, revenue, which is recognized over time. If we go back to the original slide in step 5, we talked about revenue being recognized at a point in time, and want to talk a little bit more about this particular revenue recognition. So revenue recognized at a point in time if criteria for recognition over time aren't met. So that's one of the determining factors if there's nothing to recognize over time. So what are some of the indicators that you need to consider whether control has been transferred? 1, is there a present right for payment? 2, who has legal title of the asset that's then been created? Has physical possession of the asset been transferred? Have the significant risks and rewards of ownership been transferred? And finally, has there been acceptance of the asset by the customer? So you can see how this differentiates from the overtime method versus recognizing the revenue in a single point in time. And as we look to these 5 different steps, you can see how voluminous these particular criteria are. As I mentioned, documenting each the thought process throughout each step is critical. How organizations will look to not only document but approach these things in the future are some of the things we need to start thinking about. But as you can see, this standard is so important, and I think the reason why that it was the ASU, which was issued in 2014, toward the end of 2014, doesn't have the implementation until now, is because there's still so much information to absorb. And as I mentioned earlier, just alone in June this year, FASB talked about the clarification regarding grants. So a lot of things, as this is being implemented, will still be evolving. Certainly, both myself and our friends at JMT will be at the forefront of making sure that everybody is well versed should there be any additional changes. So as we look at the 5-step method, we really want to then now, as we've talked a lot about those 5 steps, what criteria are involved in each one, we want to start to think a little more prospectively. What do you need to do for those nonprofits who would be a December year-end filer who are considered a conduit debt obligor? Hopefully you started to think about these things already and implement the 5-step process. For those other nonprofit organizations who will be implementing this for periods going forward, what do we start to need to think about to get ready? What are the takeaways? What do on August 2018, while we're still in summer and not quite toward year end, there's a lot that organizations can really start to do to prepare for the implementation of this standard. So we wanted to share 7 takeaways and ways to prepare and implement for this new standard to make sure that you're adequately prepared. Consider these following steps. First of all, you could probably all check off step number 1, which hopefully today, becoming familiar with the new standard, and then taking that a step further, discussing it with your accounting advisors, whether that is the individuals in your finance department. Hopefully you're already, if not, having these conversations with your auditors, as well as, like I said, the various stakeholders in your organization, making sure that both the audit and finance committee are understanding what changes this might bring to the financial statements on an annual basis, as well as throughout the year. So as we talked about, step 1, understanding this. Step 2, this is really critical, inventorying all current revenue streams. Oftentimes, nonprofit organizations may have various revenue streams, talking about contributions, talking about grants, if anybody is reimbursed through third parties, and various other revenue streams that may be affected by this. Really have to take this by inventory the streams and run through this 5-step process through each particular revenue stream, and then go through what documentation needs to be in order. As I mentioned, need to start considering the potential effect of some of these differences on the financial statements. So whereas contributions, which aren't subject to revenue recognition, are going to continue to be recognized as they were in the past, grants and other such streams will be different, and we'll have to talk about how this might be different going forward. So number 3, need to start evaluating whether there are any differences between current practices and the new standard on how you address contract modifications. This might not apply to everybody, but for those of you, oftentimes if you're dealing with any local, state, or federal governments, very familiar with contracts changing, rates changing, amendments to particular existing contracts over a period of time. This is very frequent, so understanding that is key. The 4th way is reconsidering revenue, whether it be recognized over time or at a point in time, based on the new criteria and the specific guidance. Oftentimes, systems, processes, and controls may need to be updated as a result of the new criteria and any changes in timing of the revenue recognition. So this is interesting because oftentimes, if you're only reporting once a year at year end, you may not see any large-scale differences between the revenue being recognized over time, over at a point in time. But certainly as you're preparing forecasts, internal budgets and such for, like I said, the board or the audit committee or the finance committee, this is a key step to think about, because it could show some differences than in past practice. Number 5, and just as important, historically, many nonprofits haven't really tracked costs to acquire a contract, oftentimes because they've been expensed as incurred. So in order to maintain compliance with this new standard, really need to think about the necessary resources for accumulating costs incurred that may need to be capitalized. Further, step 6, identifying data gaps between what's presently available and what will be needed for the required disclosures in the new standard. So as I mentioned, you want to have that data, you want to have that documentation for particular disclosures to be combined with some of the new nonprofit requirements coming out related to the new nonprofit financial statements. There's going to be a lot of changes in the disclosures to the financial statements. So as I mentioned, documenting each step of the 5-step process, looking at the effective accounting policies, understanding the process to implement the new standards. These are some of the things we need to start thinking about, as well as some of the qualitative disclosures. That'll help the users of the financial statements really understand the impact of the new standard. And then finally, if you're not doing step 7 already, consider preparing a mock-up of a financial to understand the impact of the new standard. Maybe take what this year looks like when you get familiar with it, when you have numbers that you consider to be reliable. Like I said, start beginning the education process of the boards and other committee members, other stakeholders. This is something that hopefully I know we're doing for a lot of our clients in terms of the new nonprofit financial statement project. We've prepared some type of implementation guide as to what the financials are going to look like with some of the key changes there in terms of the changes in restriction, changes in liquidity, some of the new disclosure requirements. I think this is a great best practice to start implementing for that, as well as revenue recognition, so you can understand at certain points in time what your financial statements are going to look like with this new standard implicated. So with that said, let's talk about the implementation process here as far as December 31, 2019 year ends for those non-public entities, which I would go ahead and presume are many of the individuals on this call. Phase 1, you want to perform a scoping and gap analysis. The timeline here says January to April 2018, but certainly if you haven't done so already, this is critical. Taking an inventory of the revenue streams, as I mentioned in the 7 takeaways, identifying those to be impacted, preparing a gap analysis of the previous guidance to the new guidance, thinking about the transition methods, the contract costs, disclosures, the 5-step process, getting the documentation in order. Right now is a great time to start doing that. In addition, phase 2, looking at the technical analysis, determining specific application of some of the issues identified in phase 1, determining standalone selling price, other issues such as specific contracts that might need to be capitalized, any other methodologies and look back periods as well. Phase 3, thinking about systems configuration and business processes. Oftentimes, if there are standardized journal entries or other particular things that you need to start thinking about. Phase 4, testing transactions and auditing internal controls, running historical transactions through parallel systems. If your GL system allows you to do this, this is such a great exercise. Auditors could perform some detailed transaction testing, certainly, as I mentioned, engage your auditors. And then phase 5, thinking about the financial reporting and the disclosures, looking at what that might look like on a prospective basis, developing additional disclosures, and the like. So we put together a similar timeline here. If you're a junior end filer, that's for the junior end, for the other non-public junior ends as well. I did want to point out some additional resources that are available to you. These are internally here at BDO. We have a Revenue Recognition Resource Center. A lot of this information that has been found on the slides can be readily available in more detail. There has been a lot here today. While we wanted to be sensitive with everybody's time and really try and keep this to an hour-long webinar and keep some time for questions, there's certainly a lot of good information out there, both in our Revenue Recognition Resource Center, and we also have a very important specific newsletter which goes even more in depth, which is about 50 pages. It's an exciting read, trust me, if you need to fall asleep at night, but I kid, it's really an important resource as well. And with that said, like I said, I wanted to be sensitive to everyone's time, leave a few minutes for questions. I apologize in advance if I did go through some of the slides a little quickly, but wanted to allow some time here for some questions.
Wonderful, Matt. There was a question about if there was a basic best practice donor policy for smaller nonprofits with budgets of less than $5 million.
So I don't think that's the case. Unfortunately, everything here is going to have to be on a standalone basis and on an a la carte basis. But I think as you look to your accounting policies and procedures, there's probably enough practical expedience and examples in the ASU itself that would allow you to be compliant for a small organization that you can implement into your own accounting procedures and in your policies manual for documentation purposes. You know, I would think for an organization that size, perhaps, you know, a lot of the funding comes from contributions. If not, I'm not sure how many particular inventory revenue streams you might have, but you would think it might be a little easier to document based on the number of revenue streams that you might have.
Great. Also, are in-kind goods and services subject to new revenue recognition?
So that's a great question. They are. However, the process to document that is going to be much easier because it's almost looked at as some type of quasi-contribution. So you don't need to quite go through this 5-step process. I think you can easily document the transaction price. I think you can easily document all the deliverables as well. You have an estimated valuation as to what the services are to be performed. So.
Okay. So there is some confusion from people who are thinking that they've already built some of these processes into how they handle things. For example, a nonprofit in behavioral health receiving state grants for services has to encounter out the grant given to us. They then record the grant as a revenue grant from the organization that pays for it. Is there something more that you think they should be doing?
No, I think with an instance like that, where there could be some potential modifications, you still have to go through the 5-step process. I know oftentimes a lot of the criteria, you're at the mercy of the particular funding source in the social service organization. Fee-for-service arrangements are unfortunately subject to revenue recognition. So oftentimes it might be a little easier to identify the contract, determine the transaction price. So I don't think there's going to be a lot of change. I think there will be more of just making sure you have everything documented properly in terms of the 5-step process relative to each service that you're providing or each particular implied contract with the state or federal government.
Okay. So would a 501c3-4 would this apply to them, or as a quasi-governmental agency, would they be exempt from this?
So this standard doesn't necessarily apply just to nonprofit organizations. This is for all entities. It does apply. It would really depend on, I think, the revenue stream itself. The type of organization really doesn't matter. It's based more on the type of revenue. So depending on the C3 or the C4, depending on their funding, that's really the determining factor of application. It's for all non-public entities. All public entities are subject to this new ASU.
Okay. Would you recommend doing a single-year presentation for 2019 if someone is not implementing until January 1st, 2019? They usually present comparative statements, but 2018 is going to look way off from 2019.
I think that's a great idea. I certainly would consider that. And like I said, maybe start putting together a mock-up. I know oftentimes the ease of having a comparative financial statement helps a lot of the users of the financial statement compare year to year. But as far as that and some of the other changes that are coming forward, as far as the nonprofit guidance, I would certainly recommend that for simplicity as well as to avoid any confusion as well.
If someone receives a donation in advance and then they're creating the revenue budget for it that covers 12 months of the fiscal year, should they distribute the revenue monthly? And what implication would there be if the grant period crosses the end of the fiscal year?
So that's an excellent question. It depends on how often you're reporting to your board or your committee. If you're presenting everything on an annual basis, oftentimes there may not be a change based on some of the criteria. But if there is, you need to look at the overtime criteria versus recording it all at once. If it goes over the contract period, you need to see if there are any stipulations or any performance obligations which would cause you to have to defer some of the recognition.
Okay. So I did receive a number of questions about the slides being available for download, and we will provide them after this. If there are additional questions, we do have a few minutes left for that. I was also asked for an example of point number 5 from page 48, but I don't know if that's feasible for us to go back to right now.
So point number 5 being the financial and reporting disclosures. What I would suggest if you're looking for an example, the ASU itself has a lot of this information in it. To give an example, it would really, it's not something that unfortunately is cookie cutter. It's really distinct to each revenue stream as well as each particular organization. So I think you might find some practical examples in the ASU itself, which I think would be helpful.
So I am not seeing any additional questions at this point in time.
Yeah, I did just want to share with everybody that should you have any additional questions or comments, I know there's a lot of information in here. I'm certainly available to reach out to if you decided on any follow-ups.
All right. Well, thank you so much, Matt. Thank you, everyone, for joining us today for our expert speaker series. Again, I want to thank Matt for his time. We hope that you enjoyed the presentation and that you'll join us for future events and webinars. You can find our upcoming webinars and events by visiting us at jmtconsulting.com and clicking the Events tab. This concludes our webinar, and have a great day. Thank you.
Thank you.
Thanks, everyone.